babyface Gary Tan from Posterous on there. All right, ARM officially filed its F1. It's kind of like an S1 for a foreign company, and they plan to go public next month. ARM's revenue last quarter, $675 million, down 2% year over year, up 7% quarter over quarter. Fiscal full year 2023, $2.7 billion-ish, down 1% year over year. ARM's major business, just so you know, is smartphones. 99% of smartphones are built with ARM's chip architecture.
Embedded systems. They have an
Embedded
ISA
systems,
for embedded
yes.
systems.
Yeah, we'll get into it.
The problem is the market has totally moved. When SoftBank bought ARM, it was probably like the last year where, there was so much focus on the hardware and platform technologies inside of mobile and tablets and all that stuff. But in these last few years, think of what's happened. We've had a massive shift to AI, right? And so that's pushing a lot more pressure on GPUs and whatever comes after that. We have had a reemergence of the popularity of RISC-V, which is an open source competitor to ARM. We have had Apple in-source a whole bunch of their own architectural decisions in silicon design because
they don't want the dependency.
They have a
want
tightly
the profits.
coupled philosophy. Yeah.
Well, they also care about different things. Like they care about battery life. So that's why, that's the focus of their chip architecture.
And so all of this just means that market, embedded systems, becomes more and more constrained and commoditized over time, which again, as we said, in capitalism means that future profits will be less than historical profits. And so I think this is a very tough valuation to get right. And trying to stretch to a $60 or $70 billion print, I think is really tough. This is honestly a $15 to $20 billion company.
Ouch. So question for you, Chamath, and I'll open it up to the Davids. Why would SoftBank, I know the answer, but I'm asking you so you can explain it to the audience. Why would SoftBank take a company public with these headwinds, with no growth, being flat? Why are they taking it public now?
Well, SoftBank has to de-lever, right? They have a very big problem, which is that they have this, forget SoftBank Vision Fund for a second, but SoftBank itself is a telco operator that has ginormous piles of debt that they've used to finance the building of their business. And so when you have contraction in your core business, you become more and more at risk of breaching the covenants of all that debt, and or you just like run out of free cash flow. Like all of these things really hurt your future ability to invest. And so SoftBank is under a lot of pressure to just clean up the balance sheet and de-lever. And so when you have an asset like this sitting there, if you can sell, 20 or $30 billion of that, call it, to somebody, and then replenish your balance sheet, that provides tremendous liquidity and relief. And they did that as well a few months ago with Alibaba. They've started to, I think now they may have sold out of the overwhelming majority of the position in Alibaba, again, because they have massive liquidity needs because they have so much debt. So this is just part and parcel of them de-levering the balance sheet.
So they're forced to get it out, is I guess what you're saying. Yeah. And then we've talked Sacks a little bit about other companies that are going to be forced. They're on the, what do they call it when you're on a pirate ship? They make you walk the plank. I'd say this is like the walking of the plank to an IPO. You got other companies that have issues where they just have to get public at some point. So maybe the public markets are going to open up. And in some cases, it's going to be because people are walking the plank. Other cases, it's going to be opportunistic. So maybe you could talk a little bit about your thoughts on that.
I think it's hard to walk the plank into the public markets. I'm not sure exactly what you mean by that, because the public markets have to want to buy your issuance. So if it's not a good company, then, in this environment, they're not going to be able to IPO.
Well, they're going to be able to IPO. I think the question is the price. They have no choice but to get this out.
So there may be a lot of down rounds into an IPO from the last private round, which was 2 or 3 times what the IPO price is going to be. Maybe what you mean by walk the plank is that, well, you tell me, but there are a lot of companies which have built up huge pref stacks because they raised too much money at the peak at valuations that are too high. And going public does allow you to reset your whole pref stack because all the preferred with all of the rights and preferences converts to common. So post IPO, you just have common. Yeah. And so it is a way to clear out all the structure and all the mess that has built up in a company, and you can get to a real valuation that reflects basically the truth of what the company is worth. Another
analogy might be the house is on fire. You're on the balcony. You got to jump or you got to stay in the burning building.
Yeah, but listen, if your company's on fire, I don't think you're going to be able to IPO. I mean, it's going to be a tough, scrutinizing public market for new offerings. I think that the scenario in which you can IPO is if the company is fundamentally good, it will be able to IPO at some valuation, and that valuation may be a significant down round from their last private round. Those will be able to get out.
Yeah, and that's Stripe, I guess. Now, are you seeing...
That could be Stripe, yeah.
Are you seeing, David, the M&A activity starting to bubble up in your portfolio or in, the back channels? Because I'm starting to see that a bit. Founders are packing it in some instances and saying, you know what, we want to try for M&A. Or, some companies are getting a little bit frisky and saying, hey, what's available in the market on the small side? So are you seeing any M&A action?
Not a ton yet, but there's definitely a growing number of startups who are realizing that what they're doing is not working and they're not going to be able to raise another round. And so therefore figuring out a graceful exit, whether it's an acqui-hire or some other type of landing.
Got it. Those might be the accurate walking the planks.
Yes, those are the walking the planks. You're going to start seeing a lot more of that for sure.
Friedberg, your thoughts on the public markets here in relation to privates and people walking the plank?
I don't think there is a public market right now. There's no IPO window. This ARM thing is, pretty forced. It seems it's not like there's a ton of pent up public demand to buy these ARM shares. At least that's what it seems. So, they're going to go shop it. They're going to find out what the market tells them it's worth. And then we'll see. NVIDIA is going to help buoy it, I'm sure. There'll be an argument that, all boats will rise and ARM will be a beneficiary. But I don't know if that necessarily leads into the IPO window being open again. I think we've all heard the commentary from Morgan Stanley that they don't think the window's opening until Q2, Q3 of next year, maybe. I can't remember the exact commentary. But as we all know, a lot of LPs in venture funds and private equity funds are waiting for the IPO window to reopen before they're going to start reallocating capital back into the private venture funds because they need to get liquid in order to be able to recycle capital back into the next class of funds. So this glut right now, this inability to kind of get companies public is certainly weighing on folks. You effectively have three options when you're running a private company. You got to keep raising money, which means either raise private capital or go public. And we've talked about the challenges of raising late stage private capital if you've had a high private valuation in your prior round. Going public is very difficult right now because a lot of folks are still digesting and having indigestion from the last couple of years. Or you got to sell the company or you got to get profitable. Now, on the sell the company side, many of the acquisitions that we're seeing, with a few exceptions, are generally more bolt-on and less like, hey, I'm going to pay some big strategic premium for some big strategic game-changing company right now, because all the buyers are dealing with their own shareholder issues and their own public stock issues right now. Then can you get profitable is really, as you guys know, where a lot of folks are going, which is totally restructure your ambition, restructure your plans, and build a business where customers are willing to pay you money and where you can then take that profit and only reinvest that profit and not invest more than that profit. And if you can get to that steady state, you can live to see another day, another year, another decade. And those businesses, by the way, that we saw in the dot-com boom and the global financial crisis, that were able to do that during the doldrum Death Valley march that everyone's going through right now, they emerged victorious. They learned how to be frugal. They learned how to be nimble. They learned how to really focus on customer experience because they had to increase retention and they had to increase the prices they were charging. They learned how to be efficient with allocating resources. And so profitability became a core part of their DNA and their ability to succeed. So I think this is really a trial era. And, on the other side of this trial era, a number of very high quality companies will emerge. But in the interim, I don't think that there's an IPO path that a lot of folks can just check the box and say, hey, let's go ahead and go public, even if the valuation's not great. Remember, an IPO process, you got to oversell your book or the bankers won't underwrite it. So if they're, you can't just say, hey, the price is now $5 and expect bankers are there. If a company's burning money, the big concern with going public right now is that there is no pipe market. There is no ability to do secondary, to do follow-on offerings. So the company can't raise capital after it's public. So unless you're actually profitable, your option of going public right now really isn't there, because shareholders don't want to buy shares in a company that may run out of money.
Yeah.
And that would end up, yeah.
Yeah, and to your point, if you take this third option and you become really resilient and you have profits, Chamath, that seems to me to be the setup for the next boom that we could experience in the coming years, hopefully, which is we don't have companies that are burning, mountains of cash. People are getting to profitable. These businesses look great. And then if the big companies are now, having their stock prices recover and they've laid off 20,000 employees and they got people returning to the office and they're fit and they're strong, hey, that's a setup for strong companies buying strong companies or those strong companies that are private.
The M&A market is dead as a doornail. It's more dead than the IPO market. So 2 days ago, the European Commission and the CMA in the UK said that they're probing Adobe Figma because they have some concerns that it's going to limit competition in the market. It looks like Microsoft will have to give a 15-year license to video game streaming to Ubisoft in order to get the UK folks to agree to their Activision acquisition. So you're talking about, in the first case, a $20 billion merger that may not happen because the CMA, they found their footing. They clearly had a win in the Microsoft Activision thing, and now they're probably going to find issue with the Adobe Figma thing. And the Europeans don't want to be left out in the action, so they're jumping in. So I think the M&A market is effectively dead. What it leaves is an IPO market, but that is very tenuous because you don't have a leading candidate that can really catalyze something. And I made this prediction earlier, but I think the only company that can really catalyze things would be if people
SpaceX.
were ready to do Starlink. I mean, it's the most obvious, natural, logical thing that would just get everybody excited and off the sidelines and into the arena. But that may take another year. May not, but it may. In the meantime, I don't think there's any company like Instacart. I don't think people are going to be jumping off the sidelines. Arm, it'll be tough. Even Stripe now is like a very complicated valuation trade. And I think that that's a really technical thing to be involved in an IPO like that, a technical valuation. And so companies have no choice except to get profitable and get to default alive, to use the famous Paul Graham quote. That's the only path.
That's it. Yeah, I mean, suck it up.